Sometimes you get that feeling like there are some companies out there that are kind of hidden gems in the market.
Oh, yeah.
Like companies that could really be these huge winners in your investment portfolio.
Absolutely. Ones that people aren't really paying attention to.
Yeah. And that's what we're going to talk about today. We're doing a deep dive into RTX.
RTX.
You might know them better as Raytheon Technologies.
Right. Formerly Raytheon Technologies.
Yeah.
Big player.
Yeah. So they're massive. And they're in both commercial aviation and the defense sectors.
That's right.
So we've got this really interesting analysis based on a recent article from the Motley Fool. And we're going to figure out if now's the right time to add them to your portfolio.
Yeah, the goal is to break this down, look at what they do, look at the numbers, and try to get a sense of what their future might hold.
Exactly. So the big questions we're going to try to answer today are pretty straightforward. First, is RTX undervalued right now?
Okay.
Second, what kind of growth can we expect? And then finally, are there any potential risks or headwinds?
Right. Things that could throw them off course.
Yeah, exactly. And just so everyone knows, all of this is based on an article from March 15th, 2025.
Got it.
Okay, let's break this down. So first, can you just kind of explain to everybody listening what RTX actually does?
Sure. So RTX has two major arms to its business. One is commercial aerospace.
Okay.
So they provide a lot of the crucial components you need for airliners, aircraft engines, avionics, all that sort of stuff.
Yeah.
And then the second is defense.
Okay.
So they're really a huge player in the defense industry. They make things like missiles, missile defense systems, radar technology, and all sorts of other advanced military tech.
Wow. So two pretty critical industries right now.
Yeah.
And the article we're looking at makes the point that both of these sectors are actually doing pretty well right now.
Yeah. That's a good place to start. I mean, for commercial aerospace, we're seeing a really strong rebound in flight departures.
Makes sense. I feel like everybody I know is traveling again.
Yeah, exactly. So people are getting back to traveling. Airlines are trying to keep up, and that means there's a lot of demand for RTX's products and their aftermarket services.
That makes sense. So the demand is there. What about on the defense side? That feels like it's been in the news a lot lately.
Yeah. No, you're right. The defense sector is being impacted by some really major events going on globally. The conflict in Ukraine is still going on.
Right.
And there's a huge need to replenish a lot of military equipment. And then you're also seeing a lot of NATO countries significantly increasing their defense spending.
Oh, wow.
So for big defense contractors like RTX, this is actually leading to record levels of backlog.
Record backlogs. That sounds pretty good. So with all this good news, how does the article try to figure out if RTX is a good buy right now?
So they use a metric called price to free cash flow. Or PFCF for short.
PFCF, got it.
And basically what they're doing is comparing the company's stock price right now to how much free cash flow it's generating per share.
Okay. So can you explain what that means in simple terms?
Yeah, sure. It's like trying to figure out how much you're paying for every dollar of actual cash the company has after they've paid for all their expenses and any investments they need to make.
Okay, that makes sense. So a lower PFCF means the stock might be a good deal.
Generally, yeah. Especially when you're comparing it to the company's own history or its competitors in the same industry.
Okay.
So this article gives us a bunch of numbers. They show RTX's historical EBIT, which is earnings before interest and taxes.
Right.
It's a way to measure how profitable their operations are. And they show free cash flow, too, from 2023 all the way through to 2027.
Okay. So walk me through some of these numbers.
Sure. So in 2023, they had an EBIT of $8.9 billion.
Okay.
And a free cash flow of $5.5 billion.
Right.
And that gave them a PFCF of 31.3 times.
Okay.
Then in 2024, their EBIT went up to $10.2 billion.
Okay.
But their free cash flow actually dipped to $4.5 billion.
So that's not great.
No. And it pushed their PFCF up to 37.7 times.
So that doesn't sound like a bargain.
Not really, but things start to look better when you look at the projections for the next few years.
Oh, consider it.
So for 2025, they estimate an EBIT of $11 billion.
Okay.
And free cash flow is expected to bounce back to $7.1 billion.
Oh, so it goes up.
Yeah.
All right.
And this brings the PFCF down to 23.9 times.
Okay.
And then it keeps going down from there. So the estimate for 2026 is a PFCF of 20 times based on $8.6 billion in free cash flow.
Okay.
And then in 2027, it drops even further to 17.3 times with $9.9 billion in free cash flow.
So if that actually happens, that sounds pretty good.
Yeah, and the article says that for a mature industrial company, a fair PFCF is usually around 20.
Oh, okay.
So yeah, based on these projections for 2026 and 2027 RTX could be undervalued.
Interesting. But didn't they have some issue with one of their engines that might mess with these numbers a bit?
You're right. So their 2025 free cash flow is going to be impacted because of this issue they had with their GTF engine.
GTF?
Yeah. It stands for Geared Turbofan.
Geared Turbofan.
Yeah. Anyway, they had to set up this whole program to remove and inspect the engines because of a potential contamination issue.
Oh, wow. So how much is that going to cost them?
It's estimated to be somewhere between $1.1 billion and $1.3 billion.
Okay, that's a lot of money. So
Yeah.
how does the article adjust for that when they're trying to figure out if RTX is actually a good value?
So what they do is they take the midpoint of that range, which
Right.
is $1.2 billion.
Right.
And then they add that back to the original free cash flow projection for 2025.
Oh, so they're basically saying if it weren't for that one-time issue, they would have had more free cash flow.
Exactly. So when you do that, the adjusted free cash flow comes out to about $8.35 billion.
Okay.
And then their PFCF for 2025 drops to 20.5 times.
Okay, so once you factor in that engine problem, things are looking better again.
Yeah, exactly. And there's another thing to keep in mind.
Look at.
Companies in defense and commercial aerospace usually have higher valuations anyway.
Why is that?
Well, for defense companies, their main customer is the government.
Right.
So that means their revenue is more stable and predictable.
Makes sense.
And then commercial aerospace companies make a lot of money from servicing and supplying parts for aircraft engines and stuff.
Okay.
And aircraft last for a long time.
Right. They do.
So that means they have this really long-term revenue stream.
Yeah, it makes sense.
So all of that means that a PFCF above 20 isn't necessarily a bad thing for these companies.
So we've looked at the numbers, and it seems like RTX could be a good value. What about the future, though? What does the article say about that?
So the near to medium term outlook looks really positive.
Right.
They have a huge backlog of orders,
Okay, how big are we talking?
like massive. At
Yeah.
the end of 2024, their backlog was $218 billion.
Wow. $218 billion.
Yeah. And to put that in context, their sales that year were only $80.8 billion.
Oh, wow. So that backlog is like way bigger than their current sales.
Right. So that means they have a lot of revenue coming in over the next few years.
Yeah, that's a good sign.
Mhm.
And I know you said earlier that their defense backlog was especially strong.
Yeah. So their defense backlog hit a record $93 billion.
$93 billion.
Uh-huh. And their book-to-bill ratio for defense was 1.48 for the whole year.
Okay, can you explain what that ratio means again?
Yeah. So it compares the value of new orders they get to the value of sales they bill.
Right.
And if it's over 1, that means they're getting more new orders than they're fulfilling.
Oh, so that's good.
Yeah. It's a sign that they're going to keep growing in the defense sector.
Okay, so defense is looking good. What about commercial aerospace? Any good news there?
Yeah. So both Airbus and Boeing, the big aircraft makers, are planning to increase their production rates in 2025 and beyond.
Oh, wow.
And since RTX supplies parts to both of them, they're in a really good position to benefit from that.
So it's not just about making new planes. Right. They also make money from servicing existing planes.
Right. That's the aftermarket, and that's a big part of their business, too.
Okay.
With more people flying, there's more demand for maintenance and repairs and spare parts.
Yeah, that makes sense.
RTX's management is actually predicting about 10% growth in the commercial aftermarket in 2025.
Okay, so we've got strong backlogs, growth in both commercial aerospace and defense. Sound pretty good,
Yeah.
but there's always risks.
Of course, no investment is without risk. And this article talks about a few things investors should be aware of.
Okay, like what?
Well, one big one is defense spending.
Okay.
It's not as simple as it seems. Yes, NATO countries are spending more,
Uh-huh.
but there's a chance the U.S. might actually cut its defense budget.
Really?
Yeah, the article mentions that the U.S. Defense Secretary is considering cutting the budget by like 8% each year.
8%. Wow.
Yeah, if that happens, it would definitely impact companies like RTX.
So all those big backlogs might not mean as much if there are no new orders coming in.
Exactly. So investors need to keep an eye on what's happening with government spending. It's not a guaranteed thing.
So it's not just about how much money is being spent, but also the terms of the contracts, right?
Absolutely. The U.S. government is getting tougher in negotiations.
Really?
Yeah, they're doing it with all the big defense contractors. Lockheed Martin, Boeing, RTX, all of them.
Interesting.
And it's especially true for these fixed price development programs where if the costs go over budget, it eats into the company's profits.
Oh, that makes sense.
And all three of those companies have had issues with this recently.
So it makes you wonder if the U.S. pushing NATO to spend more is partly because they're planning to spend less themselves.
Yeah, it's possible. The article even suggests that. Maybe they're trying to balance things out.
So maybe this boom in defense orders isn't going to last forever.
It's possible.
And-
Something investors need to think about.
Okay, so bottom line, RTX has a lot of potential, but investors need to be cautious about the future of defense spending.
Yeah, it's kind of a mixed bag. The near term looks good, but the long term is more uncertain.
So just to recap for everybody listening, we've looked at what RTX does, how they make money, and we've analyzed their financials. We've seen they have a lot of potential for growth in the near future, but there are also some risks related to defense spending. What are the key takeaways here?
So I think the biggest takeaway is that RTX is an interesting company with a lot of potential, but it's complicated.
Right.
There's no easy answer.
Yeah.
They've got a lot going for them with commercial air travel recovering and high demand in defense.
Uh-huh.
And when you look at their valuation, especially after adjusting for that engine issue, it seems like they're undervalued.
But the article also suggests that maybe RTX isn't going to blow the market away.
Yeah, that's right. You have to remember that defense spending could change and that could affect their future performance. So while it might be a good investment, it's probably not going to be some crazy huge winner.
Okay, so it's a solid company, but investors should definitely keep an eye on all those things we talked about.
Definitely. Things are looking up for them now, but things could change.
Well, this has been a really fascinating look at RTX. I think it's really interesting to see how all these different things like the recovery in travel, the situation in Ukraine, and how governments are spending money all affect a company like this.
Yeah. It really shows you that you can't just look at the numbers when you're thinking about investing. You have to look at the big picture, too.
Absolutely. So here's something for everyone to think about. How might things change if there are even bigger shifts in global politics, or if governments change their spending priorities?
Yeah.
It's not just about the U.S. either. Other countries could change things too.
Right.
So that's something to consider when you're making investment decisions. Thanks for joining us for this deep dive into RTX.
Thanks for having me.